Victoria, what exactly is happening with this market, and should investors be scared?
Well, Dom, I mean, obviously the coronavirus issues that we're seeing are driving the moves in the market. We thought we were making some progress there. China was reporting that we were getting lower new cases every day, and that really made the market feel better. We saw it turn around and really move higher last week and the beginning of this week. But now that we're seeing new cases develop, we're seeing new cases in Singapore, new cases in Korea, and new deaths occurring outside of the mainland of China, then people are starting to get concerned again. And the question really comes down to how much disruption are we going to have? Some of these smaller private companies in China, our research is showing they only have about 2-3 weeks worth of cash flow left to really make it their way through this tragedy. So they're going to have to see things turn around pretty quickly. Some of the more state-sponsored entities have a little bit longer, maybe 2-3 months that they can go. But we're starting to get to that point where those supply chains are going to have massive disruptions. We're seeing it in retail companies, transportation companies. They're reporting it in their earnings calls. That's what's driving the market right now.
All right, so Victoria brings up some interesting points here, John, with regard to that. She also kind of hinted at this idea that we've seen some of these things in the past. There's been a historical precedent. The coronavirus, though, in your mind, is it fair or even appropriate to use some of those historical precedents for what's happening with this particular outbreak?
We'd have to think so, Dominic. When we look at it, I can recall traveling to China in the first quarter of 2004 after SARS had peaked. And we put this all in context, and we think China is better prepared to deal with it now as a result of on the ground, you have many global multinational healthcare companies that can help out with this situation. We think the main effort needs to be boosted by transparency, an effort to get greater confidence in terms of the data. And of course, the disconcerting thing is that, you know, you've got this pickup of cases in Korea, Japan, and Singapore, the results of which tell you that this isn't going to be as short-term as many people expected. That said, these viruses tend to peak in a relatively short period of time. We think it's kind of late to get defensive here, with the defensive sectors, particularly in equities, richly valued.
Now, Victoria, was yesterday's price action the midday slide where we watched the Dow, in essence, fall by 200 to 300 points in the matter of a few minutes? Was that a wake-up call? Is the market positioned in some way right now where we could see more of that kind of intraday volatility? And does it mean, or will it be a precursor to more extended slides later on down the line?
Dom, I wouldn't be surprised if we see more slides coming like we did yesterday. Obviously, when you have new news that comes out that's talking about new countries where we're seeing some of these cases start to increase, that's going to cause concern and bring that uncertainty back into the market. We know the markets don't like uncertainty. That's what drives the volatility. So I wouldn't be surprised if we continue to see some of that. But as we've spoken before, and what we tell our clients is they really need to have to strive to look through the headline noise that they're seeing, focus more on some of the longer term investments. You don't want to trade on these headlines right now because I do think they're going to turn around pretty quickly, probably in the next quarter. So look a little bit longer term, see what trends you think are coming in that format, and that's where you need to be investing.
All right. So John, it's interesting. The headline risk certainly is something that's been considered noise by a lot of folks, especially because markets sit near record highs. Yesterday aside, though, it seems kind of lately that investors, they just can't lose, right? They can buy bonds, they can buy gold, they can buy stocks, they can buy just about anything, and they all go up in value. Stocks near record highs. The dollar index is at its highest level in more than a year. Gold is at a 7-year high. I could go on and on and on. Virgin Galactic, Tesla. What's behind the so-called everything rally, and should you tread with caution here?
Well, we'd have to think that the everything rally is particularly distinguished by Tesla, for example, and other issues that are moving forward that are unrelated to what's happening with the coronavirus, but are related towards longer-term trends in technology. Some of these things look a bit frothy, but we think at the core, if you look at the S&P 500. The S&P 500 is a broadly diversified index and has many opportunities, we think, that are intermediate to longer term, still remaining attractive within technology, consumer discretionary,
Sure.
Industrials, and financials, all of which have been dinged a bit by what's happening here. So we think you have to separate the
Okay.
excitement from the core.